Let us talk about the markets then, Mark. Let's start the clock and reflect a little more on what we're seeing here. European equity market futures at this moment, Eurostoxx 50 futures extending their declines to minus 1.1%. It seems with that and the surge in commodity prices and the fact that yields have sort of resumed that move to the downside, today starting to look a little bit like yesterday in terms of that crucial and perhaps not seen very often relationship.
Yes, I think it's seeming actually more gloomy than yesterday because it seems like a more logical risk aversion. Yesterday kind of started with a bit of a panic and then we started kind of recovering during the session, and it seemed like the early selling was indiscriminate and that's why it was easy to recover. Today we have a narrative. Now, I'm not saying this narrative will ultimately prove correct, but we have the market coalescing around a narrative, and that is a stagflationary narrative. It is bad for risk assets, but it is seeing commodities surge and it is seeing bond yields come lower because it is saying central banks will not be able to react to the strong inflationary impulse that we are seeing from commodities markets.
Yeah, and is that why we are going to be able to see then yields falling and oil prices going to the upside? Is that going to continue? I know on the question of the day you've been asking this question because it doesn't necessarily look logical if oil prices are going to drive inflation higher.
I don't think it can continue for too much longer. I don't know when the exact turning point is, but the central banks around the world are too far behind the curve to look through this inflationary impulse, even though it is the wrong type of inflation, as that's called. It is a negative growth shock, supply-side driven inflation. They're still too far behind the curve, and therefore they must react to it. So I think that central banks will hike aggressively, as Goldman and Bank of America are still insisting. The Fed will stick to their plan, their aggressive rate hikes this year. When we go back to trading that narrative, I don't know, but I expect it to happen relatively soon. We're in the process of cleaning out excess positioning in the short end of the bond market. Once that is cleaned out, we can go back to trading the fact that central banks will have to hike rates. So I think that we're going to start trading this as inflationary, not just stagflationary.
OK, so maybe it doesn't last for all that long, that relationship between the two, Mark. Where is the latest thinking on havens at this point? Or maybe not even havens, but markets that are relatively unscathed by this? I know some colleagues writing about whether there can be resilience in Asian stocks, for example.
The longer-term theme here is all about what's happening in commodities markets. Russia is not relevant to the global economy apart from its military, which we're seeing, and apart from commodities. Now, the commodities angle cannot be underestimated. It is massive, which is why we are seeing this explosion in commodities prices. But beyond that, there's not a direct economic impact. So therefore, we got to look at inflation, and therefore we got to look at the yields impact. So the biggest driver of risk aversion this year, barring the more extreme military scenarios for the global world, is the fact that we're going to see tightening financial conditions. So you've got to be worried about expensive stock markets that are going to be most affected by that. US stocks will be very, very vulnerable for the rest of 2022. Never talk about the next few weeks, whereas havens like Hong Kong might actually do better because they're already discounted.
Right, despite the fact that we are seeing, of course, concerns around the latest dealings on COVID-19 there, but we'll keep that in mind. Remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV GO, that is the function to use on your terminal.